the way it's marketed of how easy it is to become financially independent. And that is true to a certain point, but you also have to understand that it's very, very active to get to that point.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point podcast listeners. Thank you again for jumping into another episode of the Freedom Point. I'm your host, Jeremy Dyer, and today I have an amazing guest, Denis Shapiro. Denis, welcome to the show.
Jeremy, thank you so much for having me. Can't wait to get this one started.
Yeah, absolutely. You bet. And a little bit of information on Denis before we get started. Denis began his investing real estate journey in 2012 when the market was just beginning to recover from the global financial crisis. He built a cash flowing portfolio, including many alternative assets, such as note and ATM funds, mobile home parks, life insurance policies, tech startups, industrial property, short-term rentals, affordable housing communities, and more. Denis, you've got quite the track record there of having invested since 2012 in multiple different alternative asset classes. Can you tell our listeners a little bit more about what you're currently focused on?
Yeah, so these days, when we first started, it was mainly on the limited partnership side, and we kind of took, I guess, an old school approach of before actually becoming operators, becoming investors first. It was easy at that time because I was a W-2 employee. I was working for the government at that point in time. So we ended up investing in various asset classes. And then when we got onto the operational side, we actually focused on the affordable housing and then the short-term rental side. So it's kind of like a what do they call it? The wind at the cipher, where we had a lot of asset classes coming in, and then it slowly started filtering out, and then we kind of got our core focus, which was at the end of the day, the affordable housing, and then it was the short-term rentals as well.
So let me understand this. Back in 2012, you're still working a full-time W-2 job. At that point, you've got some discretionary cash sitting on the sidelines. You start investing as a limited partner investor. And then at what point did you then pivot to being active, general partner investor? Were these through joint ventures? Were you a GP? What did that transition really kind of look like? And really, why did you decide to make that transition in the first place?
That's a great question. So when we first started in 2012, honestly, I didn't even know better. It was a very eye-awakening experience to just find out that there are these things called private securities, and you can invest in them. At that point, I was a traditional investor. I was investing in the stock market since I was 14 years old. So I was probably at that point 10 years in. I kept coming across the same issue on the traditional side of things. My stock portfolio was appreciating really, really well. The problem is every time I tried to invest for income, that's when I started having problems. And I tried all the different strategies that they recommend, such as, high dividend portfolio or MLPs and REITs and all of that, those kind of strategies on how to create additional income. And I ended up realizing that the way that algorithms and the way that these stocks trade in unison, the stuff that worked 20, 30, 40, 50 years ago that provided that steady income doesn't do that anymore. So what ends up happening is you end up underperforming your regular S&P 500 index fund. And then on top of that, when there's a downturn, it goes down just as much as anything else. So I realized that there was a problem in my portfolio, and that's what attracted me to alternative investments, because alternative investments actually fix that problem. And I was actually one of the only guys out there saying hey, you don't have to actually sell your whole stock portfolio and get into alternative investments. You could figure out that a piece of your portfolio that's on autopilot and appreciates is really useful for you. But then you could complement it with these alternative investments that really, really produce the cash flow. So initially, as an LP, that's the only opportunities I had. I was working 60, 70 hours a week for the government. I didn't have time to be an operator. So at that point, I was really zoning in on the alternative investments for the cash flow and also the tax benefits. I invested in a single family property right after I got my first W-2 paycheck. I went online, I Googled, how do I pay less taxes? And after the first page of semi-legal recommendations, the next group of recommendations were all, buy real estate, buy real estate, buy real estate. So I bought a single family that turned into a complete nightmare. It was a low income area. Ironically, it was also affordable housing. And I cut my teeth on that property, and I realized I didn't want to scale that way. And that's what really, really got me to the limited partnership side of it, because I knew I wanted some of the benefits of real estate, but I didn't have the time. I didn't have the network. I didn't have anything else that you really need to get onto the operational side. So that was my journey. I want to say from 2012 to 2018. In 2018, I relocated to New Jersey. I was originally from New York. And I met someone who was also interested in this, and we kind of made this game plan, and we said, hey, let's either go out and buy a couple of smaller multifamily, 6 to 12 units, or relook at these whole LP deals. And we went and we toured a couple of properties, and we were on the fence if that was the right strategy or not. And then I started getting more and more offers for the syndication side of things. And that's when I was like, you know what? Why don't we just group together? A third person came in the picture at that point. We grouped together and we did like 10 to 12 of these limited partnerships. And that's what really kind of took my career off, because then I had the data. Then I saw what was actually working, what wasn't working. And then through networking, I had an opportunity to do a joint venture, which I always recommend to people who are considering active to get involved with a joint venture. It's like the perfect hybrid between a limited partner and a general partner. So I got to follow along on the deal. I got to check in on meetings. I got to see if this was be a good fit for me. And then at that time, I also was starting to approach, I had 10 years working for the government at that time. I was starting to look for something different. And it kind of worked out really well, where I had this experience as a limited partnerships. And then I had these joint venture opportunities. And I saw that the future was more into this than with my government job. And then over the next 6 years at that point, I started transitioning from the limited partnership side to the operational side.
That's great. So Dennis, let me unpack something that you said earlier on, and that was this pivot from, we'll call it public institutional grade type investments to, really, private placement, private equity type investments. Your primary driver or focus in making that decision was seeking cash flow. Now, of course, we all know that stock prices go up and stock prices go down. We also understand that real estate values can accelerate, faster or slower depending upon where we might be at in the economic cycle and also the ultimate business plan of the operator. So talk to us a little bit more about, why you would recommend that investors seek diversification in both, we'll call it Wall Street, and in Main Street, especially if they're looking to build up a portfolio that produces consistent cash flow as opposed to just an equity upside?
Yeah, that's such a great question. So I'll preface that as saying that none of what I'm about to say is financial advice. This is just pure opinion from someone who's been investing in stocks for over 20 years and investing in private securities for over 10 years. So for whatever that's worth, I realized really early on that the two make like a perfect yin and yang circle. For example, in the stock world, right? If you go out and network with a bunch of CEOs, you're most likely going to be in jail in 5 years for insider trading, right? It's frowned upon. But in the alternative space, you could become best friends with 5 or 6 operators, and you'll have inside knowledge that can propel your investments. The other big thing is when I was heavy into this traditional side and wasn't doing anything on the alternative side, I was spending a lot of time trying to do my homework on the stocks I was buying. So I was getting on the quarterly calls, I was listening to the CEOs, and I was reading the reports and these analyst reports. And then at the end of the day, I realized that everything I did was almost a complete waste of time. I was better off putting it in an index fund and then spending 1% of my brain power automating my traditional investments with a good index fund, and then spending 99% of my time. And then there's that yin and yang of 1 in 100, right? And then spending 99% of my time networking, where fostering relationships with alternative investments can 10x your investments, because it really is about the people who you network with and your relationships. So they complement each other so well. And I only really hear that you should only do one or the other from someone that has alternative motives. Like a financial advisors who don't do private securities are huge in pushing traditional, and they brainwash their clients and really tell them about, oh, there's so many Ponzi schemes and all that, like Bernie Madoff never happened, right? Or WorldCom or all these other basically scams never happen. And the truth is, scams happen because of bad people, and there's bad people in private securities and public securities. So you get this fear mongering in the financial planning and financial advisor community, because it's all for them. At the end of the day, it's usually assets under management, and they fear that takes away from what they can get. But then on the other side, you have this plethora of, I would say, newer capital raisers out there that realize that so many people have so much money in the traditional world, and they're saying, like, don't you want the security and the less volatility and the look at these 20% potential returns, because they're trying to take money from people's IRA accounts, 401k accounts, and they're trying to divert them into their investments. So it's rare to get this yin and yang balance and to realize, like, hey, they both have pros and cons. Neither is perfect, but combined, they are a really powerful wealth generational tool if you look at it as a whole.
Yeah, absolutely. I think that you brought up some really good points there in terms of, where the motivation is, right? Because oftentimes you just need to follow the money to determine where, the motivation lies. And certainly with your financial advisors, nothing negative about that type of a position or a role or an occupation. But really at the end of the day, they're salespeople, right? They get paid a commission to sell a product. They get paid, incentives based upon the amount of assets that they're, quote unquote, managing in your portfolio. But at the same token, the operators, the sponsors, the syndication teams that are out there today that are looking to raise private equity money, from an investor base, they also have a motivation, and that is they need to raise the capital or they can't buy the deal, right? So everybody's gotten a certain, motivation, in terms of, why they're looking, for investor capital. But the thing that I really like about what you stated is that, with private investing through syndication or private equity type investments, the investor can get on the phone and talk to the jockey that's riding the horse. The investor can get on the phone and talk to the pilot that's flying the plane, so to speak, right? But if I'm a shareholder and I'm invested into an index fund, do I really know who's, steering that ship? I don't. And even if I did, I'd probably have no ability to actually have a dialogue with that individual. Does that make sense?
Yeah, just because you go to Disney World doesn't mean you could get on the phone with Bob Iger.
Touche. Yeah, absolutely. You had brought up something before as well that I wanted to unpack a little bit, and you talked a little bit about networking and leveraging, that to find, different alternative investments out there. What's kind of the main, place that you're going today to, to access, information related to, alternative investments? Is it LinkedIn? Is it some other platform?
Yeah, so this is, again, a really, really great point. I feel like I've reached the stage where I already have, where if I never go out to another event again, like I already have my partnerships, I already have my teams in place. I'm okay. But rewind to day one when I was getting started. I am a firm believer you could really use LinkedIn to get started, and not in the way that most people traditionally think. So LinkedIn is a little bit of like the wild, wild west type of thing. So what I always recommend is if you're brand new and you're interested in investing in, let's say, commercial real estate or any other alternative investment, go under your name and just put investor, right? And put apartment building investor, right? Anything, if you're a startup investor, whatever it is. what's going to end up happening is within days, you're going to start getting bombarded with 15-minute meeting requests. When you're brand new, those meetings are actually very, very helpful because you don't know the language of commercial real estate. You don't know the terms being sent out to you. And yes, you're probably not going to be friends with this person in 10, 20 years, but it does not hurt to get on the phone and for 15 minutes hear the terms, hear what an IRR is, hear what a cash on cash is, write down the terms you don't know, and then go after the call and look them up and, really figure out what you need to know to learn the lexicon of commercial real estate. I always also recommend that people take some basic underwriting courses as well. Those are like the two steps that I always tell a new investor is like learn some basic underwriting. You don't need underwriting to the point where you're making offers, but you need underwriting where you can ask, valid questions. So those are the things where I think LinkedIn is really, really good. It's almost, those calls are almost always a waste of time, at least starting out when people are like reaching out to you. However, it does play a role in learning the language because once you learn the language, that's when you should go for the outpatient. I'm not the outpatient. The meetings. That's when you should go to your local RIA meetings and the conferences. Because what ends up happening is if you walk into a conference or a meeting and you don't know basic terms, you're gonna come off as a very needy person because you're gonna come off automatically looking for someone to help you versus someone who's understood the language, understands what they're looking for. Hey, I'm looking to invest in a 50-unit apartment building in this specific geographic area. Like that's the stuff you need before you start going out there, because when you start saying what you're looking for, that's when the attraction starts coming to you. Versus if you're coming to a meeting and say, well, I don't know what I'm here for. What do you do? And then, oh, tell me more about what you do. And then that person's going to spend 45 minutes and you're going to walk away. And that person's going to be upset walking away because they just wasted their whole night talking to someone who hasn't done basic homework. So that's what I always recommend. I do think the quality of conferences has kind of diminished a little bit since I started going to them in 2018. It seems like because there are more capital raisers out there, there's a little bit more of an imbalance. Before, I remember in 2018, I would go in and for every maybe one capital raiser, there was 20 investors in the room. Now I feel like that number is almost like 50-50. So you get, I think, a little bit less quality conversations. But either way, I think it is really important. Almost every single one of my partner I met was through a conference or a meetup. And also take advantage of interesting opportunities that do come up in real estate or alternative investments. And I'll give you some examples of this. One of the best networking events I ever did was for an investment I did as an LP. And then the operator basically did an open house for that building. And this was in North Carolina. And then I ended up going to that and I ended up carpooling with someone who was local to me. And then he ended up being my main partner. And he's the reason why I got into affordable housing, because during COVID, I couldn't fly down there and the operator actually connected us. So those are those weird opportunities where, especially when operators are hosting events at a specific investment, those are the best opportunities because yes, there might be an element of sales involved, but you're seeing a live product, you're seeing a business plan, you're seeing their vision. Like those are the best events ever to go to.
Yeah, and I'm a big fan of, sometimes you just have to show up, sometimes you just have to, find a way to get in the room, so to speak, right? And that's where some of those, best relationships that I've ever had and built, over time, have come as a direct result of me willing to really put myself out there and show up. You talked a lot about some great things, as far as if you want to get into real estate as either a limited partner investor where you're, kind of along for the ride, so to speak, or you want to get in, as an active real estate, owner on the single family or small multi side, or maybe even large multifamily side. You talked a lot about the importance of, education, obviously talking to other operators that are already, in the space today, learning the language. One place that I've found to be incredibly valuable for me is just, tuning in and listening to other people's podcasts. You can learn, more about what the host knows, more about what the guests that they're bringing on, knows about the space. And obviously, books and meetups and all those kind of things are incredibly important. So I really appreciate you sharing that with us. It's kind of the same, message that I share with potential passive investors or limited partners is, I love the fact that people know, like, and trust the operator, or they know, like, and trust the capital raiser. But at the end of the day, everybody still has to do their own due diligence. Everybody needs to spend time, on their own, really understanding and unpacking, some of the common themes in investing, including things like the IRR, the cash on cash, the equity multiple, the DSCR. There's a number of different, things out there that I think it's really important for people to understand and know. And you also brought up a really good point, and that is, investors really should, to a certain extent, understand how to dance around an underwriting model, right? Understanding, what are some of those, stress tests that can be applied to the underwriting, which could have a direct correlation to, the actual performance results, itself. So really appreciate that. My next kind of question that I wanted to ask you a little bit more about is, can you identify, or how did you identify and capitalize on unique opportunities in alternative assets, like specifically notes and ATM funds? You're involved in a lot of different kind of non-traditional, asset classes outside of your kind of traditional multifamily space, which is where the majority of my own personal investment dollars are allocated to. So tell me maybe a little bit more about some of those others that you're in and why you're bullish on them.
So I guess I'm becoming a little bit less bullish on them as I've gotten more opportunities on the multifamily side of operational. So I've shifted more from any investment that I have a limited role in versus investments that I have a major role in. I always would rather invest in those for obvious reasons. But in terms of ATM, when I first got into the space, I think I first invested in an ATM fund in 2020. I ended up doing a lot of due diligence for it because I wrote a book on alternative investments, and ATM funds was actually one of the books I mentioned. The book is called The Alternative Investment Almanac. And what's interesting is I found out the ATM space itself was like a really high Ponzi scheme space, just because of the fact that it's a lot of cash going in and out. What made me comfortable with it was the network that I ended up building up. One of the people who I consider like one of my mentors, he really walked me through the due diligence process of how you actually vet an ATM fund investment. And that's what ended up making me more comfortable of investing. And for those who don't know anything about ATM investing, it's a very interesting business model. For people who are aware of like the apartment building investment, there's a certain amount of cash flow you get throughout your hold, and then there's a bigger back end, capital return, either when it refis or when it sells. That's usually the return cycle. So let's say you get 5 to 7% for year 1 through 4, and then year 5 there's a sale, and then you're getting your multiple. In ATM investing, it's almost like a guaranteed income for 7 years, and then your investment's worth 0. So it's a very, very tricky one to understand the IRR because there's a certain amount of principal coming back every single day. But it's a good investment for someone who is looking for cash flow, as long as you're willing to do the due diligence, really know the operator. I think I've wrote a couple of blogs on like the actual checklist that you should be doing. There's certain certifications these ATM operators have. And then at this point, from my understanding, there's really one really big ATM fund operator in the space. And then there's like 10 or 12 capital raisers that kind of branded it themselves, but the underlying asset is this one really big ATM fund thing. So it's all about comfort level. So with us, we started with ATM investing. We have an income fund, and we started with ATM investing, but now we've kind of been replacing the ATM investments with private lending that we've created in the last couple of years, just because we have full control of the private lending. We okay every single deal. We deploy the cash. It has very similar returns, a little bit easier to understand the returns because you're getting a fixed, rate of a fixed interest rate, and then you're getting your principal back. So it's a little less complicated than the ATM. But so both of them, I would say hard money lending and ATM, they both provide, ample amount of cash flow. It's just which tool is right for your portfolio. That's, a personal decision.
Yeah, absolutely. And one big component to that decision is also the tax benefits through depreciation, as I understand it, through ATM investing, because it's a piece of equipment, as opposed to a piece of real estate. That those depreciation benefits can be, in some cases, 2 or 3x what they would be, in the multifamily or real estate space. Am I saying that correctly?
You are, and because they depreciate down to zero, they're basically worthless at zero. So you don't really have to. Again, I don't want to say this for a fact, but I believe the recapture is not there because you have a property. Basically, you have something that's zero at the end of the day, so you don't have to fully recapture it. So it is. There are more tax advantages with the ATM fund versus hard money lending. But however, you could always do hard money lending in like a self-directed IRA, and then you could kind of get the benefits away from. So there's multiple ways of doing it. It's just a matter of what's right for you.
Yeah, absolutely. Let me just ask a couple more questions before we wrap up. And that is, what would be maybe 1 or 2 common misconceptions that you hear out there about investing in real estate syndications?
So number one is how passive it is. So it is only passive once the money is wired. Till the point that it is wired, you should be as active as you freaking can be. Like, I can't stress this enough. So many people invest based on reputation, saying, "Oh, this person has a good track record, blah blah blah," but their track record is from 2018 to 2022. That really does not tell you how they perform in a down market or a raising interest rate environment. So again, there's a lot of due diligence, a lot of education you could do. That it's not a walk in the park. You shouldn't just be blindly wiring the money. However, once you do wire the money, that is at the point you have to trust that you've done all your homework on the deal, the operator, and then you have to trust the operator at that point. So number one is definitely how passive it is, and I hate the way it's marketed. It's marketed all over its social media of how easy it is to become financially independent and how everything. And like, yes, that is true to a certain point, but you also have to understand that it's a very, very active to get to that point. So number one is definitely the misconception, the passivity of it. Number two is the tax benefits are overstated in a lot of deals, and this is where a lot of people. Let's give an example, and it's actually becoming a little bit less today than it was in the last few years, because last few years cost segregation and there was bonus depreciation, so it was much more frequent. If you were doing a deal, you definitely were doing a cost seg. But let's say, hypothetically speaking, you were investing $100,000, and the operator would kind of market it as like, oh, we're expecting 35%, in losses. So if you put $100K in, you'll get $35,000 worth of losses. And they stop right there. They don't further explain that those losses are passive losses and that you may not be able to use them because you're not a real estate professional. And all of that stuff that's really nuanced, and someone who's maybe this is their first deal and is really excited to go to the CPA, and the CPA is like, oh, it's great, you got these 35K in losses, but you had no passive income, so they're just going to stay suspended. And then you're like, well, that's not how it was explained to me. So that's a really big one. The other thing that's not mentioned enough is depreciation recapture. So basically what happens when the deal sells, and a lot of times these deals sell at the end of the year for tax reasons, because the other team wants to buy it and do a cost seg and everything like that. So a lot of times you'll be notified in November that your deal just sold a week ago. And now all of a sudden, all of those negative losses that you got are going to be recaptured. And then all of a sudden now you're facing a huge a tax bill. So those are the two biggest misconceptions out there, I think. I think it's just a byproduct of how it's marketed. And then I think it's also a byproduct of a lot of newer capital raisers that are in this space, and they don't fully understand these terms, so that they know that these are buzzwords, but they don't fully understand the behind it, the background of it. Similar to how a lot of operators didn't really understand variable interest rate loans and interest rate caps. So, which is a different side conversation. But I just think people think that just because someone posts something on social media, that makes them an expert in the space. And there's frequently times that does not.
Yeah, absolutely. And that goes right back to what we talked about before. And that is the investor really needs to do their own due diligence. They need to get educated on these terms and understand, some of the things that we're talking about. And my listening audience is known for a little bit of time now that I'm in the process of writing a book. And one big part of that is to address, some of exactly what you're stating here as well. And I agree with you wholeheartedly. We put a lot of emphasis on this word trust in real estate, but I've said this to people a lot before. There are a lot of people in my life that I trust, okay? But there's a lot of those very same people that I would never trust with protecting, that fiduciary responsibility of $100,000 investment, right? And also you talked a little bit about track record, right? Just because somebody has had an amazing track record and run over the last 5 or 10 years does not mean that that track record is going to continue. And the reason for that is because none of us really have direct control over what the economy does, right? We didn't know that the Federal Reserve Bank was going to increase the Fed funds rate by 550 basis points over a 16, 18-month period. We just didn't know that, right? There's all kinds of other, events that have occurred, in the past over history that none of us really had any control over those events occurring, right? And so again, just because you have a track record in the past and the history does not mean that that same, track record is going to continue, into the future. So, and then for the comment that you made on the tax benefit side, for those that are listening to this episode, you can look back several episodes ago. We did have, in fact, a couple of CPAs on that talk specifically about, what those tax benefits are to limited partner investors that do not claim the real estate professional status. We talked a little bit more about, that depreciation recapture and what exactly that looks like, towards the end of that investment as well. So Dennis, this has been wonderful. Can you tell us maybe what's next for Dennis? Do you have any specific goals as we look kind of towards the back half of 2024?
Yeah, so we're definitely one of the smaller boutique private equity companies. We only have a few partners, so we don't do 100 deals, but a great way to connect with us. We spend a lot of time working with our investors, and the best place to reach us is SIHcapitalgroup.com. Capital is with an A. Another great resource is my book, The Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways. You could find that on Amazon. The way I structured that book is that it gives you a 15-minute overview of the asset class. So I featured most of the common ones that we kind of come across on a daily basis. So you got mobile home parks, self-storages, startups, apartment buildings, private lending, and you get a 15-minute snapshot of what that asset class is. And then it goes into my favorite part, which is a Q&A with 2 investors from that space. Some really big names came on my book I was really thankful for. And I asked them the exact same questions. So they're broad enough to apply to multiple asset classes, and it's really interesting to see how they each answer the questions. And the purpose of the book was to basically give someone a chance to get to know an asset class without having to read 300 pages about it. And then they could turn around and then they could dive into podcasts that, specialize in apartment buildings or mobile home parks, because now they have a sense of, hey, this is an asset class that we want to get into. So I strongly recommend reading the book. And then get into SIH Capital Group. You could click learn more and connect with me. I'll be glad to jump on a phone call and build a relationship.
Perfect. And we will put those links in the show notes for this episode. And Dennis, again, really appreciate you joining me on the show today.
Jeremy, thank you so much for having me. I can't wait to read your book as well.
Yep, sounds good. Thank you for that little plug at the end here. And listening audience, thank you again for joining us on another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.